Thank you everyone for joining with us again on a Friday evening, where we get you one industry expert and discuss a trending topic every week. And today's topic is international investing, why and how to invest in global markets. And our expert for today is Mr. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund. It's always fun doing session along with Mr. Sunil as he brings fresh perspective to every topic, and he simplifies the concept in such a way that even a layman can make complete sense of concepts of investing. Then we have Mr. Shikhar, who will talk on the Groww platform, and I am Rishabh Lunia from Novice Learning Academy. So in next 1 hour, we will take you through all the nitty-gritties of international investing. Be with us, and if you have any questions relating to this, please put it in the comments section, and we'll try to answer most of them at the end of this session. So before we head to Mr. Sunil and hear from him, I'll quickly run you through a small presentation on some of the basics of international investing. So let me quickly share the presentation. So here it is. Now, so the topic is international investing, how and why we should be investing into global markets. So for most of us, our day starts with an alarm on our Android or iPhone, after which we check our WhatsApp or Instagram. Then some of us will wear their Reebok or Adidas shoes and go for morning walk. While doing their work, they might open the Google to check to the latest news, and they come back home, start working by opening their Dell or HP laptop, which runs on a Windows processor to do their official work. And after the day long hard work, we would like to unwind by watching some latest shows on Netflix. So if you've seen, I've talked about so many different brands, and it's most likely that there is not a single day where we don't use these products. These names have become an important part of our day life, and now we don't search, we Google, we don't stream, we Netflix. So this is the influence of these global brands on our life, and across the country the trend is similar. So the big question is, do we want to be happy by just becoming consumer of these big brands, or we would like to be investors in these companies and make money as they grow leaps and bounds in future? But what is the option? Because most of these big brands are not listed in our countries. So is there a way out where we can invest in these companies and can make more money for ourselves? Yes, definitely. And today that's the topic of the day. It's called international investing. So we'll be talking about how through local mutual funds you can take exposure to global brands and global companies and give your portfolio that added boost in terms of return in the coming future. So now the first question is why we should go international. The reasons are obvious. The first and the foremost reason is the diversification which it brings to the table. Now, when I say diversification, what kind of diversification it gives? It gives us the geographical diversification. Now, when I say global diversification, we can see the brands which you see on your front, all big names, but they are not listed in our country and we cannot directly put our money into these brands. So through international investing, through international funds, these big brands become available to us by investing into international funds. Now, why additional diversification is always better? Because if you look at normal investing, most of our money is invested into our own country, and it has country specific risk, whether you call it political or geographical. Anything happens within the country will impact the investments made within the country. But when we go global, we are actually moving away from the country, and we are trying to take benefit of economies who are flourishing with better demand, economies which are doing good in terms of GDP, and within those economies, selecting some good brands, good stories, which can unwind a lot of wealth in future for all of you. So this is the first and the foremost reason. Now, does it make sense by investing into other countries? So here's a small snippet for you to just understand that last 6 years, if you take from 2015 to 2020, no economy, we have taken 6 large economies of the world. No economy has done number one ranking for 2 consecutive years. So if one country tops this year, next year it is some other country who's topped the chart. And this makes complete sense in terms of, okay, if we are going global, I am actually benefiting from other economies which might be doing better than my own home country. So if you see here, in 2015, where Nikkei has given 9% return, where Sensex was down by -6%. And if you look at the current example, last 2020, there were economies which were down by -14%, but COPSI as a country, Korea as a country, has given 30% positive return last year. So this gives an added, I would say, push to international investing, because there are pockets of, I would say, alpha, which these fund managers can explore and create wealth for your portfolio. Now, just making a comparison, because a lot of people are interested to invest in US, because after seeing some great performance since 2009 onwards, after 2008, I would say global meltdown, US have been on a rampant growth, and it is one of the, I would say, longest bull market which US economy have seen. So if we just make a comparison between how US and Indian markets have fared in last decade or so, you would see there are again lower correlation, because in 2011, when US has given positive return, we were down -15%. Again, if you look at 2019, probably 2020, Indian markets have done better than the US. So the correlation, which is low between these two economies, also make great sense of investing into that economy. And the third and another very, very valid point to look for investing into international market is that currency diversification. Not only geographically you are diversifying, but you are also investing into other currency which tend to do better than your home currency. If I just take example again of US, the US economy, because of the performance of the US economy, dollar has been appreciating continuously against rupee in last entire 1 decade. And if I have to put percentage, I think last decade it has appreciated almost at a rate of 4% on an annualized rate. So I think it was about 45 in 2000, and today it is close to 75. So when we know that there is an economy which tends to do better in terms of currency, when you diversify and invest into that currency, and when that appreciates, your investment value in that economy also will appreciate. And a lot of individuals who are planning to send their kids for higher education to, let's say, to the US, for them it makes additional sense to be investing into that currency from now itself. So these are some of the broader reason why international investing makes sense in today's. So having a small share into your equity allocation to international stocks makes complete sense. Now, what are the routes through which you can invest? So most of the mutual funds in India, they have their international funds. So these funds can invest in two ways. One, either they can directly expose themselves to the stock of that country, or they can invest into funds or ETFs of that country. So there are two ways to invest. One, directly investing into stocks, and another way is by investing into the existing funds of that particular country. And if we have to talk about what are the various international funds, so there are thematic funds which invest on the basis of a certain theme. Let's say a real estate based international fund. So this international funds will attack a theme which is based on real estate. So if you feel real estate in that country works well, you can invest into that particular fund. Then there are country or region specific funds which target a certain country or a region in particular. So it can be Africa, it can be US, or it can be, let's say, top 5 rising economies. Depending on their choice of country or region, they can launch a specific international fund. And the third one, which is very, very generic, where they do not have limitations. The fund manager is having entire globe as its universe. All the listed stocks in various countries are the universe which fund manager can choose, which is called the global market funds, where you can invest into various economies. There are no restriction on fund manager that you have to only be specific to any country or be specific to any theme. So this is very, very similar to what we see the diversified funds in our country, but those funds are restricted to our own country, whereas these global market funds take you global, and fund manager has more, I would say, leg room to take a better decision to put your money. So in nutshell, this is some basics which I would wanted to share. And now we will move to the expert of the day, Mr. Sunil Subramaniam, who is the CEO and MD from Sundaram Mutual Fund. So I'll just request Mr. Sunil to take over from here.
Hi. Can you see my screen?
Yes, I'll just stop sharing. Yeah, now you can share, sir.
Yeah. Hi. Am I audible? You're able to hear me?
Yes, sir. Go ahead, sir. It's loud and clear.
Good evening, friends. So I think perspective. So a lot of what I'm going to say is maybe repetitive, but I'll try and give you something additional, more than what Rishabh has. So it is why it makes sense. Okay. So first thing, as Rishabh mentioned, it's about geographic diversification. The first one I want to look at is the internationals of your stock market exposure. Because people use the word international as if it's one bucket. No, international means a whole of geographies in terms of stock. And as Rishabh mentioned, his own cycles in terms of performance. Sense of it, he mentioned in March 1st, March 31st, December of last year and September of last year, just to show you how in 6 months, the Dow Jones, NASDAQ, S&P on the market. Can you see the wide variation in returns? And so the returns. And next slide shows you 3-year returns. So the simple point is astrologers who predict which market I should be, which point of fall like. Can somebody tell me whether they're able to hear me?
It's still a little.
Hello?
Voice a little distorted yet.
Yeah. I'm using the mobile hotspot, but still it's saying internet is unstable. I don't know what's the reason.
Yeah, now it's
So
slightly better.
anyway, let me continue. You're able to hear some
Yeah, you can
yeah,
keep.
but the slides are at least visible.
Now you can share again. I think it got
The
disconnected.
slide for a little longer. Okay. Yeah. Can you see it now? Rishabh?
Yes, sir. We can go ahead. I think you can just close your video because
Can you? Somebody just responded that they can hear me. So that's fine. So I'll continue. But okay, I'll close my video just to save on the bandwidth. Okay, fine. So let me continue. Okay, so it makes sense to be invest of them at least some portion.
uh, sir, I think the voice is breaking.
The second portion, the companies invested. Say this is one.
Sunil sir, I think the voice is still breaking. What I'll do is, yeah, I think he has dropped. Yeah. I think Shikhar, in the meantime, you can start with your session, and we will try to resolve with.
All right. Okay.
Yeah.
Sure. Welcome to Ab India Karega Invest. I will be talking to you about the Groww product, and I'll be walking you through all the features that we have and the things that are in pipeline. I'm mainly here to answer your questions about Groww. So in the Q&A session, if you have any questions about Groww, about whatever we do, please do leave them in the chat box, and I will address them. For now, I will very quickly share my screen. I hope my screen is visible. Rishabh, is it? Okay, great. Okay, so as you all know, Groww is all about making investment very, very simple, very, very easy. When you download the app, this is the screen you'll see. Signing up is extremely simple. It takes a few minutes. It's all done via your smartphone or laptop. It's 100% paperless. And if your KYC is not done, we'll get it done. You just have to use your email ID, preferably a Gmail email ID, and your phone number, and a few other relevant documents. If your KYC is already done, you can start investing within minutes. And if it's not, then we'll get it done. So that's not an issue. When you open the app, when you log in, you end up on this screen, which we call the Explore screen. So the Explore screen is divided into three parts. There's stocks, there's mutual funds, and there's gold. And as and when in the future we add newer products, they'll all appear here. So here in the particular picture you're seeing, we're in the Explore screen of mutual funds. At the top, you can search for any stock, mutual fund, or any other detail that you might want to search, ETFs, etc. And below this, you can see there are things like the popular mutual funds, collections of mutual funds based on their types, so on and so forth. Likewise, if you tap on stocks, this is the stocks Explore screen where you have stock related details. And likewise, if you tap gold, you end up on this screen where you have Augment Digital Gold, which is our digital gold offering right now, But in the future, we'll be adding more digital gold options besides Augment Gold. So whenever you type a mutual fund's name or you find a mutual fund and tap on its name, you end up on the fund screen. This is what the screen will look like. It has all possible details of a mutual fund that you might need. So it has things like expense ratio, the fund manager's name, past performance, what all stocks or bonds or instruments it's holding, its performance compared to its competitors, so on and so forth. So everything that you might need to know about a mutual fund, you already have them here. Likewise, the same is true for a stocks page and also for the gold page. Now, there's a common misconception that I've observed in the mutual fund world, which is people tend to think that they can invest in SIP, which is a monthly investment in mutual funds only. But that is not true. You can also make one-time investments, and you can make one-time investments in mutual funds that you already have an SIP in. There's no limit as such. There's nothing stopping you from making newer and more investments. In fact, you can make multiple SIP investments in the same mutual fund also. This is the dashboard screen. So dashboard refers to your investment. So explore was for you to explore mutual funds, stocks, and gold. The dashboard is for you to see your investments. So in this case, again, there are three tabs. There's stocks, there's mutual funds, and there's gold. And under that, you can see your investments, how they are performing. You can see their details and so on. If you tap on any mutual fund's name, you will be shown more options wherein you can choose to withdraw or redeem or sell or invest more in the same mutual fund. So that looks like this. And here you also have the option of seeing more details, wherein if you tap, you will be taken to another page where it's like a passbook where you can see all the mutual fund transactions you made with that mutual fund, other details like average NAV, your folio number, so on and so forth. Right at the bottom of the dashboard screen, there's an option called import. Now, if you have mutual fund investments that are not on Groww, that you made via some other platform, via someone else, and you'd like to move them all to Groww because it's all in one place, it's easy to see in one dashboard, you can do that using the import option. Again, it's very easy. You have to just give your email ID, which is linked with those investments. Just tap on that button. It's very easy to follow. Just follow the instructions, and within a few steps, you'll be able to track your mutual funds. Now, switch is another very important, very popular feature that people tend to use after having imported funds. So let's say you have these external mutual funds which are not on Groww, and they're regular plan mutual funds where you are paying a commission, and you want to move them to a direct plan where there is no commission being paid. So switch allows you to do that. So first you have to import mutual funds to Groww, and then you have to switch them to direct. This is another thing that I wanted to talk about, Groww Digest. So every single day at the end of the day, Groww prepares a report of the highlights of the market and in general the world and India. So it contains all the biggest developments, but the selling point here, the unique selling point that I can confidently say not many or very few people are able to offer is that it contains very little jargon, it contains very little fluff. It's very precise, it's very to the point, it's very concise. You can finish reading this in 3 or 5 minutes max, right? So that's daily. And likewise, we have a weekly digest, which also is a bit longer, it's a bit more, it has more investment lessons in it. This is already, if you're an investor or if you're registered on Groww, this is already reaching you via your email every single day and every Sunday. If it's not reaching you, you can read these digests at this link, groww.in/digest. I'll repeat, groww.in/digest. So this is something we've been working on for a very long time and it's finally out. So please do go and check this page out. For any other doubts that you might have, any questions you might have for us at Groww, please email us at support@groww.in. If you are stuck somewhere, please make sure you use our very expansive help and support, which is on app and the website. And most of the users who use help and support are able to find resolution to their problem there. If not, you can always raise a ticket using via the help and support section. You can raise a ticket and you can call us, you can chat with us, or you can also email us. Please follow us on Facebook, Twitter, LinkedIn, and YouTube. YouTube is, again, I'm saying this, is a very great resource if you're a new investor. You can learn a lot about investing, especially in the stock markets, from our YouTube channel. We usually upload around 3 videos per week, but sometimes we can do more than that also. That's it. I come to the end of my presentation here. I think Sir is back with us. So we'll resume with that. And after that is done, we'll take questions.
Hi there, folks. Sorry about that technology glitch. I hope you're able to see me.
Yes, sir.
And hear me too. So Rishabh,
Yes.
can you do me a favor and just share the screen?
Yeah,
And I'll just pick it up from there. Excellent. I think just go down a couple of more slides. Next one. Next one. Yeah. So you can pause on this one. So as I was saying, this is the second aspect. So just in case you missed the first one, diversification is the key reason to international. And in international, diversification comes from stock markets. What we just saw, those two tables, tells you that different stock markets perform at different points of time. It's impossible to predict which market is going to give you the best return. So put your eggs in a lot of baskets in terms of the stock market. Second, the companies that you buy are as critical, because when you buy single country companies, right, then their stock market reflects only their local earnings and you're only getting the same diversification. But if you choose a company which is diversified across geographies, like Coca-Cola, look at the diversification. Its home territory of North America is only 34% of its business. 66% comes from the rest of the world. Next slide, please. Apple, only 45% business comes from the Americas. If you buy an Apple stock, you're actually buying businesses in each one of these geographies. Next slide, please. Louis Vuitton, the famous global handbag and all other accessories maker. Look at the diversification of his business. Next slide, please. BMW, the car manufacturer. Europe, its home geography only is 44%. 56% comes from the rest of the world. So that's the second reason why. So to an investor anywhere in the world, these two things make sense. That is, outside their country, they invest and they buy companies which are spread across the rest of the world. But for an investor based in India, there are additional benefits, some of which Rishabh touched upon, but I will take you through my thought process. First, surprise, surprise. You think by buying Indian stocks, you're buying the Indian consumption story in its fullest? Absolutely not. Why do I say this? To benefit from the Indian consumption story, you need to go outside India, my dear friends. So next slide will tell you that many global of these MNCs, that is the big companies, are actually consumer brands. And their largest target segment, the middle class, where is that located? The next slide will show you that China has 350 million by 2030 and India 380 million. So put together, we are talking about 750 million middle class buyers situated in these two. So any MNC worth its salt has to invest in these two countries, right? Have business there, right? So many of these companies coming back to India have been in India for many years and already are benefiting from our growth. Unfortunately, if you go to the next slide, these companies are not listed in India. So if you want to participate in the Indian consumption story, you have to buy these stocks outside of India. Take Amazon. Look at the growth in its sales in India. It's listed in the US. Next slide. Google. That one was a drop for that 1 year, but again, next year there's been a rise. Google India. Apple. Right? All these, like he mentioned, no, you Google something, you do that on your iPhone, you're using these products, your hard-earned money is going into these products, but the profits are reflecting in the share valuations in some other goddamn country and some other stock market. So international investing helps you fully take advantage of the India growth story, right? So that's my second point. Next, you will think, oh, these are global brands. They are invested all over the world. Their valuations will be too costly. Why should I go and base? No. The reality is that they are not that expensive. Let me take some examples for you. Next slide. So here I'm comparing Louis Vuitton, which is a global brand, where Titan has now gone across into jewelry, into watches, into other kind of fitness gear. Look at the difference in valuation. The left-hand side graph tells you that the P ratio for Titan is 65.3, whereas for Louis Vuitton is 31.7. Price to book, again you see the gap. Dividend yield, Titan is giving you 0.3% dividend yield, Louis Vuitton is giving you 0.8, 2.5 times the dividend yield. And in international, where interest rates are 1% or less or zero or negative, even 0.8 is something decent. Next slide. BMW versus Vario or Maruti Suzuki, right? Look at the difference in valuations. P ratio of 28 versus P ratio of 8. Dividend yield of 3 versus dividend yield of 1. Again, example. Next slide, please. Take this is now taken two MNCs, Unilever and Procter & Gamble. Unilever listed in Indian stock market, Procter & Gamble in the US. Want to see the difference in valuations? 56 versus 22. And dividend yield 2.4 versus 1.8. So, my dear friends, by buying these companies, it's not that you're buying them expensive. The fact is that for the earnings and for the book value, they are actually offering very good value for your money. So MNC stocks do that. That's the second point. The third point is what Rishabh mentioned in terms of currency depreciation. Now, he mentioned that the rupee has been strengthening, right? So the global portfolio will benefit from any weakness. So the next slide tells you that 2011, 10 years ago, the US dollar to rupee was 45. Today it's 73. How much is that in 10 years? 5% per annum. Yes, in the shorter period, the rupee has been appreciating because FI has been pouring money, FD has been pouring money. But that is not a sustainable thing. Over a 10-year period, you would add 5% return per annum to your portfolio by invested in US or Europe-based stocks. But why do I say that this 5% is something you should factor in? Because this short-term appreciation of the rupee is not a long-term sustainable trend. What is the reason? The next slide is a table, right? What it tells you is that, please read the heading, that between two economies, in between two countries, what decides whether one currency will appreciate or depreciate on a fundamental value basis, not based on short-term flows, is that the difference in interest rates, that's called the interest rate parity principle, will reflect in the depreciation of the country which has the higher interest rate. So let's go down to the table now. I've shown you again various dates. Let's take the current date, March 1st, recently. 10-year GSEC, that is the government of India's borrowing rate, is 6.23. 10-year US government's borrowing rate is 1.4. What is the difference? 4.8. So according to the fundamental currency theory, the Indian rupee should weaken 4.83% per year. And how much has it depreciated in 10 years? 5%. So I think I've made my case. In fact, this short-term appreciation of the rupee is an excellent buying opportunity. It is like the correction in a stock price. Appreciation of the rupee for an international portfolio is nothing but correction in a stock price. So buy low, sell high mantra applies here also. When the rupee has appreciated, that's the time to go and buy, right? So, and I've taken your fund of us. I've deliberately not named it because I know I'm not here to pitch my fund. But since I had the data, I wanted to show you. Our fund was launched in our Singapore office in 2nd July 2015. Can you see that in rupee terms, if you're invested in the Indian feeder fund that we have, 10,000 units would have gone to 6.2 lakhs in rupees, the same fund. It's given you 1 lakh rupees more because it's invested in dollars. So straight 1 lakh hand over fist is the additional profit over and above the stock price appreciation that you have got because you are living in India in a weakening currency country, right? That's the benefit of the rupee weakness. In fact, here I've used what is it called? MSCI ACWI, ACWI. Don't get scared. It's nothing but all country world index, right? So this is a weighted average of all the countries of the world. Can you see when you convert the Nifty into dollars? That was the previous comparison. I converted dollar to rupee. Now I'm doing the reverse. I'm converting rupee into dollar. Can you see between the green graph and the red graph? The red is all country world and Nifty is green. Can you see the difference in return? Right? That is $100,000 invested then would have made you another $20,000, 20% more return because of the depreciation of the rupee. Right? So I hope that point has been well made. To summarize, the what is the purpose of all this diversification, right? Because it's a common mantra everybody uses, right? And what are the three aspects we saw? We saw international of your stock market exposure. We saw businesses spanning the globe. You saw currency, right? What is it risk and reward mean? Risk means your chance of losing money, correct? The variability of your returns, sometimes 25%, sometimes minus 25%. How do you measure it? There is a simple formula called standard deviation, which takes the mean and sees how much you deviate. The higher the standard deviation, the higher the risk. I'm sorry to use jargon here, but it's important to make a very beautiful point. So just bear with me. So, right? So when you are taking on more risk, you expect more reward. What diversification does, it reduces the risk because you're in different spaces, different currencies, different countries for business, different stock markets. But you obviously give up some of the reward, but as long as you don't give an equal amount of the reward that you took on as additional risk, when you take risk, you are better off on rewarded divided by risk. So that's the beauty of diversification, which I will now demonstrate to you with our fund. Again, this is a global fund. I'm not telling the name. Now, the left-hand side gives you the risk and the right-hand side gives you the reward, right? From the date of inception of this fund, can you see that the yellow is the Nifty, the blue is the fund, the dollar fund, okay? What are you seeing? 22% is the risk of the Nifty. Because why? It's a single country risk. 15% is the risk of this diversified portfolio. So straight away 6% saving in the risk, that's diversification. But how much of the return are you giving up? Please go back, Rishabh. How much on the right hand side is the return? The return you got from our fund was 10.6. The return you got from Nifty was 8.4. So you got not only got 2% additional return, you got 6%, 8% less risk. So can you see how that when you are sending your money outside the country to invest, you know you're taking on more risk. This tells you that the reward you get more than justifies that aspect, right? So I hope the whole diversification story has made sense. Now I want to switch to another point where, next slide please, Rishabh, where we talked about it for the currency aspect, right? That because the currency has appreciated recently, it's a good time to invest. But apart from that, there is another reason why it's a good time to invest in international. That's because the global response to COVID was a huge monetary stimulus. Into say that it's nothing but note sharp, to say it in a Hindi, colloquial Hindi, right? Note printing. So this global monetary stimulus, which all the G4, the big countries, pumped money, 2.4 trillion in just 2 months, they pumped the Fed, and they did 8 trillion over the year. And the next slide tells you, right? Can you take the next slide, please? That this return that you got across geographies was because of the liquidity. So you see, March 31, 2020 was a COVID. After they started printing, can you see the red to green shift? That's the effect of all that liquidity going in and pumping up stock markets all over the world. So international equities are going to benefit. The next slide, the same thing on a 3-year. So next slide, please. This tells you about the future, because that's 8 trillion has already happened. Now you look at the graph. 2019, they've done 13 trillion. By December 22, in the next 2 years, $29 trillion is going to be the liquidity pumped into the world economy. A significant portion will come into the stock markets because interest rates are running low, gold has started weakening. So the stock markets are going to continue to face a surge of liquidity, which will take stock prices even higher than today, right? So this gives you the same thing by breakup. We can proceed to the next slide, right? Hence, I feel that this is an appropriate time to invest in international equities. Now, having decided on international equities, how do you choose a portfolio? Because outside is risk. You don't know. Will you go and buy a mid-cap company in Korea? You don't know what the fate of the valuation is, what the fate of that company is, what its market share is. So the best way to choose is to choose quality. Quality, one method of choosing quality is to choose a brand. Why choose a brand? Next slide, please. The wondrous world. Next slide, please. The product versus a brand. A product, something can be made in a factory. A brand is bought by a customer. That's brand value. A product can be copied, but a brand is unique. A product can become outdated, but a successful brand is timeless. Next example tells you the difference between a product company, which is HTC, and a branded company, which is Apple. Both were started making mobile phones, both at the same period. see the difference in sales of Apple versus HTC, see the difference in net profits of Apple versus HTC. A product-oriented company, so why brands have an advantage? First, they can sell in multiple geographies, spanning borders. They can multiple categories. Apple is a good example, right? From mobile phones, iPads, camera industry, right? Every industry has entered. Next, bad times or good times, you need your iPhone, right? They can span economic cycles. In the previous slide, 1 minute. If I can just finish those. Second last point, build a competitive moat. Another person can't come and snatch the apple. The Apple Bhakta will always be an Apple Bhakta. That's the competitive moat. He can hike the prices, but you'll still go and madly buy that apple. And then, because of all this, from a stock market perspective, they keep generating cash, and that cash is deployed in their own business, so the returns on capital also keep growing. So this is why choosing a brand is a fantastic way to go international. Next slide, please. Right? Because this brand's competitive advantage gives superior earnings and a premium valuation, which I'll demonstrate in the next table. Right? Look at these. I've chosen 4 or 5 big brands. Look at the 2015 to 20, their growth in sales, their growth in net income, their growth in market cap, and the return on equity. Can you see those numbers? Mind-boggling. Triple-digit numbers in most of the cases, and the return on equity, cost of capital internationally is 1%, 2%. Look at the return they have been giving in their equities, right? So brands deliver consistent earnings. Next slide, please. Right? Now, if you want to say, what are these brands? This is from Interbrand, the top 30 brand. They're a brand rating agency, which is incidentally what we use in our fund. I'm just demonstrating to you the kind of companies, if you just say, okay, I'll do only the top 30 brands of the world, nothing less. The kind of names we'll add to your portfolio are Walt Disney, Apple, Google through Alphabet, Amazon, Microsoft. Each one of these is a household name for you, my dear friends, right? So that's the quality of buying. And the result of this, next slide, please, is that you will end up with a mega large cap portfolio. And what do I mean by mega large cap? Next slide. If you buy 1 share of each of these brands, you'll need 10 lakh rupees. Now you'll say, oh, I need 10 lakhs to do that. Well, if you do a mutual fund with just the same, you can do it for even 1,000 rupees. But if you want to buy your own stocks and you're keen to invest each one of the stocks, you need 10 lakhs to buy. And luckily in the international market, you can easily buy one share, right? So with 10 lakh rupees, you can build your own portfolio of the top 30 brands of the world, right? So that's the point I wanted to make. And these brands, the strength comes from their sectoral diversification. The portfolio of these 30 brands, look, 33% is consumer discretionary, 27% is IT, 14% is communication, consumer staples is 10. So you are automatically getting a sectoral diversification in your portfolio. Next slide, please. You are getting the international stock market exposure. So you go there now, such a portfolio, naturally, because lots of these brands are US-based companies, 63% will be in the US stock market, but 36% is in other advanced economy stock market. So you get stock market diversification. Next, please. And the other aspect, which is not there in the slide, which I already showed you, is their business diversification. You remember you saw Coke, BMW, Apple, how their business was diversified. I already showed the point there, so I'm not repeating it here. So you get business diversification, stock market diversification, as well as it. And the previous slide, we'll just go back 1 minute, Rishabh, if you don't mind, tells you about the PE ratios. You are talking about these big brands, right? Look at the FY21 PE, 28, FY22 PE is 20. What is the PE of the Nifty? Are you aware? So these are not mind-boggling valuations. In fact, look at their ROE. 30.8% is the ROE of these 30 companies. So you get very good earnings growth, which is justified by their valuations, and they're not overly expensive and reasonably valued. Next slide, please. Right. So having decided that, allocation to invest, how much to invest? So there you must be aware of your risk profile, right? Because your capacity to take the risk. And I have a simple thumb rule. If you go to the next slide, right? If you just call yourself conservative, moderate, aggressive, decide on your own way or with the help of Groww or who, well, I would say put 5%, 10% or 15% of your portfolio in international, right? So don't go overboard because you are adding risk there, remember, and ultimately India is a good land of investment. FIs are putting money in India. So I would say 5, 10, 15 is a very good way as a simple thumb rule for you to invest in international, depending on your risk profile. The next slide tells you that it's not just these are lump sums that I talked about, but the SIP route in investing into international is critical. You know why? Because one of the things you find that as a middle class parent today, Everybody has an aspiration to send their child abroad for study, right? So if you do that in rupees, what happens? The currency depreciation takes away half of your earnings. You saw that over 10 years, the rupee has depreciated 50%, 5% per annum. So you want to invest for your son's future abroad? Invest international for 10 years when he is the age of 5, so that by the age of 15, when he finishes school, he can go abroad. So an SIP in an international equities through mutual funds, through whatever the method, is an excellent way to build a currency hedged corpus for your child's education abroad, right? Thank you very much. That I hope was quite useful. I was able to talk. So I think now we'll move on to the Q&A session, right? Thank you, Rishabh. Thanks for the support.
Always pleasure, sir. So
I hope my voice was clear. No breakage, nothing.
It was pretty clear, sir. And I think the case which you made was even clearer. So everybody have taken a note of the opportunities which are available for all of us in the international markets. And I can see a lot of questions coming on the similar topic. So let's take a few questions quickly. Is the US markets overall good time to invest right now? So as I think Sunil sir has already mentioned, why specifically US? Would you want to address that part? Because even in most of the funds you showed, I think 60% is towards US.
So two aspects to that answer. So the US has given the best past returns over the last 2 to 3 years because the note printing was done by the US economy. So naturally they favored their country. So the past returns of US are excellent, but necessarily doesn't mean that the future from the US will be the same, right? Number one. But you can't avoid the US. Why I say this is because I showed you, right? All of these US-based companies, Coca-Cola, IBM, their business comes 50-60% from outside America. So though they are in the US stock market, you are actually getting international business demand exposure through the US stock market. So US cannot be all your portfolio, but US must be at least some of your portfolio. I think that's the right way I would put it.
And for a retail investor, what are the options which you recommend to invest globally? I think you mentioned lump sum and SIP route, but what kind of funds they can look at, and what kind of exposure in their portfolio they can take to international funds?
So I think the second question I answered, that if you're a conservative, stick to about 5% of your total portfolio. If you're aggressive, I would say put 15%. That being said, the methodology I would say is still stick to a mutual fund, because when you're going outside to an unknown territory, a guide is always helpful, right? You go into the jungle in Africa, you better take a guide with you, otherwise the lion is going to come and eat you. So you don't know the risks involved. So choose mutual funds. Today there are a range of mutual funds, but within mutual funds, there is range of risk. So there are sectoral mutual funds, like there's a consumption fund, which would have done a fantastic return in the last 1 year because all the safety money has gone into consumption. You can have a geography fund, a China fund, right? But at the same time, you can also see globally diversified funds. So I would recommend that you do global diversification because the fund manager reallocates. It's like a flexi cap fund. The fund manager will reallocate in the geography where he feels there's the greatest potential. For example, very simply, all the commodity-oriented countries like Brazil, South Africa have underperformed in the last 2 years because commodity cycle is down. But the moment world recovery starts, commodities go up, a fund manager will know when to shift into commodity-oriented geographies where the valuations are very cheap today. But that timing and movement, a fund manager will do it seamlessly and flexibly. So I would say choose globally well-diversified funds. And within that, you look what filters they are using to choose these stocks. For example, Sundaram, we have a global brand fund, which, as I told you, the top 30 brands. Some other people may have another way of filtering. But look at the filter so that end of the day, you feel comfortable looking at the portfolio, that there is a recognizability to the stocks that are underlying owned. So that should be your ultimate source of comfort. And you will feel proud that I am part owner of Apple. How many people can say that, right? So I think that's the beauty of it. So choose wisely by going for a globally diversified fund with a good filter for stock picking.
Okay, that's great, sir. I think if we are talking about US stock and this question which comes every week for Shikhar, how to activate US stock on. So over to you, Shikhar.
So I think I spoke about this last time also. A lot of the delays that you're seeing in our offerings is largely because of regulatory reasons, a lot of compliance reasons, and so on and so forth. And the limitation with US stock investment on Groww that we're facing is it is possible for many of you, but it's not possible for all of you owing to the banks you use. So if you try and invest in Indian stocks or Indian mutual funds, no matter which bank you have, you put you link it on Groww and it'll work. But that does not hold true for US stocks investing. But for many of the banks, it is possible. So my suggestion to you would be, please just write an email to us, support@groww.in, asking for US stocks, and we will see what we can do for you, because there are enough people on Groww who are actually using US stocks, and it works fine for them. So please do reach out to us at support@groww.in, and we will try and resolve this.
Thanks, Shikhar. Coming back to you, Sunil sir,
Yes.
if we are going global and if we are looking at various countries, so what are the parameters which we look generally if we are going country specific? Or you're saying that don't go country specific, have more generic in your approach? So which?
No, so in going country specific, like I would say that if the investor is constructing its own diversified portfolio, then you can choose a set of country specific funds, right? So you can diversify at your end. So my simple answer is that the core anchor of your portfolio should be the US market, for the reason that the money is printed in the US, one. Second, the US companies which are listed in the US stock market get most of their business from outside the US. So the stock market is reflecting the genuine. So core portfolio should always be the US. Okay. Now, in choosing other geographies, the key element is that if you look at the companies you buy, so if they are consumption companies, see where the consumption demand is going to go up. Like I said, the middle class in China and India is going up. If they are commodity countries, look at where the commodity is going up. So little bit of knowledge, little bit of thing is needed if you're doing your own thing, right? But one simple way which you can do is to simply take an advanced country portfolio and an emerging country portfolio and make it a 70-30. Because emerging is the story of the future, advanced is the story of the present from a stock market perspective. So that will give you a blend of present and future. So if you don't want to do too much this thing, I would say choose a 70% and advanced country geography, right? And a 30% in emerging, which will give you a good flavor of both.
Yeah, I think that was pretty clear. Another viewer wanted to ask, India is rapidly growing. Will it have any impact on the Indian currency? And will it be detrimental to invest in dollar? Because if Indian economy does well, so some investors have their, I think, doubts on that.
So 2-3 things here. So as India grows, right, two things happen from a currency perspective, right? So the key story behind currency, if you leave these short-term liquidity-driven flows, is the interest rate differential. So when India grows, what happens? When demand exceeds supply, inflation goes up. Correct? When inflation goes up, interest rates go up. So growth is always accompanied by a reasonable inflation, which means it's accompanied by a reasonable interest rate rise, which means that relative to the US, your differential will widen, so the currency will weaken. What counters this? Short-term FII, FDI flows, and if Indian exports explode, if huge growth comes in exports, that can bring in dollars, right? So FPI flows, FDI flows, and exports are the counter to the theory of the country's currency weakening. But if you look at India, that is again countered by 80% of our oil being imported. So as the growth GDP grows, our requirement of oil also keeps going up. So, right. So the export story is countered by the crude import story. So I would say on the balance, and that's why I showed you last 10 years data, right? The rupee, despite the current strengthening, has weakened on 10 years at a 5% per annum. So I would say that Indian growth is welcome, it's good, but it doesn't mean that Indian currency will appreciate along with Indian growth.
Yeah, I think that was very clear. I think one last question on the IT sector of the US. So do you feel it is currently overvalued? Because I think a lot of people have seen how these mega giants have done in last 1 decade. So will it continue for some more time, or it is overstretched?
I think that IT is a good bet to play. Okay, it may not deliver the kind of fantastic returns it's delivered in the past, but I'll tell you why it's a good bet to play. Because the COVID crisis was fundamentally another Y2K moment for the IT industry. Because the way people deal, working from home, more of surfing the internet, heavy data requirements, a new kind of a dynamic needed where companies have to live with all their people working from different geographies. So I think IT has got a boost, a kick up from the pandemic. And I think that's here to stay. So IT earnings will be good, number one. Number two is that IT companies are all global, truly global. You take Accenture, you take IBM, they are present all over the world. So though they are US IT stocks, they are a function of US valuation. Their business comes from all over the world, which is fast growing in IT business. So they are moving into that direction. So I would say just my answer is the same as the American stock market answer. IT should be a core portfolio of your international portfolio, right? IT, then consumption, but doesn't mean that everything should be there because it will give you steady returns. End of the day, the risk reward ratio in IT is reasonably favorable. It's less risk, but less reward. But I think that's a good, since you're going into a risky international arena, it's better you choose a little bit of a helmet and a little bit of safety when you're venturing into that. So I would say stick with IT. It will not disappoint you, though it may not make you super rich or super happy, but it will be decent and I don't think it will disappoint you.
Thank you. Thank you so much. I think, yes, you rightly mentioned we need that protection when we are investing. And I think with the rise in the cases, I would request all the viewers also to maintain precautions at their end and make sure that you keep yourself safe. So I think that was a lovely session again with Mr. Sunil Subramaniam from Sundaram Mutual Fund. Thank you so much for your time, sir. I'm sure I think all the viewers have enjoyed listening to you again, and they have a great perspective on international investing. So with that, we will wrap up today's session. Thank you, Shikhar, for this perspective on Groww app. And we'll catch up again next week with yet another topic and another expert. So till then, take care and stay safe. Thank you. Bye-bye.
Thank you. Thank you, Rishabh. And thanks, Irash. And thanks, all of you. And thank you, the viewers. And like Rishabh said, please do stay safe through this period. All the very best.